Hi guys, very good evening all of you. So today we are going to start with chapter 4, risk assessment and internal controls. One of the prominent areas, one of very important area, not only as a student of CA Inter or as a student of CA Final, but also when you start practicing as a senior associate or as a manager, you realize that the importance of this risk assessment and internal control is huge. It is very significant concept in practice as well. But unfortunately, when you speak with some of your seniors who have already written exam once, whether they got good marks or no, that is a different story. When you speak with some of the seniors, they might tell you that this is a kind of dry area because certain concepts are not easily understandable, or there is no linkage between their understanding and the concept given in the book. So there is some anomaly, there is some what we call noise in the minds of the students. But I tell you with all my experience that this basically is a very easy concept. Both risk assessment and internal controls, they are very simple concepts, but you should have some kind of practical application. You should have some practical experience to understand these kind of things. So let us not waste more time. We'll straight go into the chapter. I'll try to give you relevant practical examples so that you can connect. There will be no gap in the understanding. Okay. So first of all, the material that is shown to you on the screen is Institute of Chartered Accountants of India's material for quick review. So you can download this from ICI website. This is CA intermediate material, chapter 4. Surprisingly, the same topic is there in CA final level also. And more surprisingly, at CA final level also, the content more or less is same in ICI textbook printed and given to the students. But of course, the level of understanding and the intricacy with which a student has to understand the concept definitely changes from CA intermediate to CA final. Having said that, the theory remains same. Okay, so going on to the material, the first one overview, when you look at it, they have given audit risk. Okay, under that three boxes are there. Next, one more box is there, audit risk. Then in the center of the diagram, they have given risk assessment and internal control. On the left-hand side, understanding the entity. On the right-hand side, identify and assess RMM, risk of material misstatement. Under that, risk assessment procedures. My dear friends, if you have the paper, this printed copy, and if you have a pen, strike this off. This particular diagram has no meaning, no connection. Whatever the concepts, 3-4 concepts that are given in the diagram, they are not interconnected. Unnecessarily, it will confuse you. So basically, in this whole chapter, we'll be discussing these 3-4 things. That's all. Having said that, this diagram has no meaning. Okay, so straight we'll go to the first question. And the first question here is audit risk, a very important concept. So we'll discuss about audit risk in this video lecture. Open your notes, put the heading audit risk. Okay, simple. Audit risk means two things. Both of them should happen simultaneously. One is financial statements are materially misstated. Financial statements are materially misstated. MMS means material misstatement. So financial statements are materially misstated. Now, if you have little understanding of audit reporting topic, when the financial statements are materially misstated, the auditor cannot give unmodified opinion, common sense. When can I give a clean report? When can I give unmodified report? When can I give a report without any modification? As per, you might have seen in SCA 700 series, you might have studied a lot about, what is audit report? What are various types of audit reports? So simple, even in the first lesson, in the introduction, nature, objective and scope of audit, in that particular chapter also, you might have studied that the primary objective of the auditor is to express an opinion whether on financial statements To express true and fair view, he mentions two things. One, whether financial statements are properly prepared as per applicable financial reporting framework. Two, whether financial statements are free from material misstatements. Whether financial statements are free from material misstatements. That means if I am the auditor or if you are the auditor, you are conducting audit of financial statements, you do not want any material misstatement to be there in the financial statements of the client. Simple. You are the auditor. You are conducting audit of X Limited. X Limited has given balance sheet and P&L for the financial year. You do not want any material misstatement in the financial statements, correct? So financial statement must be free from material misstatements. There should be no material misstatement in financial statement. This is ideal condition, ideal situation. Now, Pavan sir, what if there are material misstatements in financial statements? So what did I say? What did I say? In the first instance, ideally, financial statements must be free from material misstatements. What if there are material misstatements in financial statements? Simple. The auditor should have competence, skill and care, due diligence, common sense, efficiency, enough to identify the financial misstatements in financial statements. That means if at all financial statements are materially misstated, I should have knowledge, skill, experience, and common sense enough to understand and to capture this is a material misstatement. I am not going to close my eyes to give a wrong report. I should qualify the report or I should express an adverse report. So financial statements are materially misstated. What am I supposed to do as an auditor? What am I supposed to do as an auditor? So what the auditor is supposed to do when financial statements are materially misstated, what the auditor is supposed to do? Simple. If the material misstatement is not pervasive, express qualified opinion. If the material misstatement is pervasive, then express adverse report. This is what you are supposed to do. This is what you are supposed to do. But what did you do? Plus one. What is one? Financial statements are materially misstated. Two, the auditor, by mistake, has expressed an inappropriate opinion. So what is appropriate opinion? Appropriate opinion is either a qualified opinion or an adverse opinion. Appropriate opinion is either a qualified opinion or adverse opinion. What is the opinion you have given? Clean report you have given by mistake. But if you go to a court of law, or in case of any professional negligence or professional guilty case on the auditor, you tell me as a student of chartered accountancy course, if I say, but hey, sorry, I am an auditor, I'm a chartered accountant, but by mistake, I have given an appropriate opinion. No one will accept and they say, hello, Pavan, come on. You cannot play victim card now. You cannot play innocence card now. Idiot, you're a chartered accountant. You know that there are frauds and errors in the books of account. You know that financial statements are materially misstated, but intentionally you did not put it out. Intentionally you have given clean report. So you are guilty. This is called audit risk, my dear friend. You understand? So basically, what is audit risk? Audit risk is expressing an inappropriate opinion where financial statements are materially misstated. Simple. That is what your beautiful material says. ये देखो. So read it. Audit risk means the risk that the auditor gives an inappropriate audit opinion when the financial statements are materially misstated. That is what exactly mentioned here. That means one, material misstatements are there. Two, you did not discover it. So what is the meaning of this? After reading audit risk, you'll understand it. One, there are material misstatements in financial statements. One, and two, the auditor is unable to detect it. There are material misstatements in financial statements and the auditor is unable to detect it. Question number one. Why are there material misstatements in financial statements at all? This is the question. Why are there material misstatements? Now, my dear friends, recollect. In your introduction classes, what did we discuss? What is a material misstatement? Material misstatement happens because of two reasons. Material misstatement happens because of two reasons. That could be a fraud, that could be an error. Material misstatement either may happen because of fraud or because of error. Now the question is, why are there frauds and errors in financial statements? Why are there material misstatements in financial statements? ICAI says material misstatements happen. Material misstatements exist in the books of account because of two reasons. One is called inherent risk, that there will be material misstatements, which is unavoidable. Even if you have strong internal controls also, there are certain, inevitable reasons, unavoidable reasons, inherent reasons that financial statements are materially misstated. Point number one. That means it is something like, mistakes do happen. Mistakes do happen. So this is point number one. Point number two, the client's internal control system, whatever the internal controls that are supposed to prevent and detect frauds and errors, they failed. Oh my God. That means a material misstatement is existing because of some reason, some unavoidable reason, plus the client's internal control system is not strong, is not effective to detect or prevent the fraud or error. So this is called control risk. Both this put together is called RMM, risk of material misstatement. What is this? Risk of material misstatement. So risk of material misstatement means inherent risk and control risk put together. Now, dear auditor, why you were not able to detect it is called detection risk. So I made a mistake. That could be because of ineffective audit procedures. That could be because of defective planning. So finally, I failed. If that is the case, that is called detection risk. So ICI has given a beautiful equation. AR is equal to audit risk is equal to AR audit risk is equal to risk of material misstatement into detection risk. The risk of material misstatement is equal to IR into CR. So basically audit risk can be expanded as IR into CR into DR. These are called components of audit risk. What are various components of audit risk? Various components of audit risk are inherent risk, control risk, detection risk. Now we need to understand what is IR, what is CR, what is DR, and what the auditor is supposed to do. Keep audit risk at a lower level. This is step two. So step one is understanding what is audit risk. Step two is what are the components of audit risk. So till now, we have completed first question. So in this, do you have any doubts in understanding what is audit risk? Do you have any doubts? What's wrong with this?